Moving on now to the panel discussion of the session, how shipping can bounce back in a world shaken by an unprecedented crisis. Gentlemen, if you can also turn on your cameras. It's my great pleasure to introduce the moderator for this session, Andrew Hoare, Divisional Director of Tankers and Gas at Pacific Carriers Limited in Singapore. And joining Andrew on the panel are Rahul Kapoor, who's the Global Head of Commodity Analytics and Research and Maritime and Trade at IHS Markit, Arjun Batra, the Group Managing Director at Drewry, and Matthew Blake, the Director of Business Development at Teekay Corporation, all based in Singapore. Before I hand over the floor to Andrew, just a couple of ground rules. You should have a control panel which pops up on the right of your screen. If you wish to ask a question, you simply need to enter your question in the box at the bottom of the control panel where it says questions. I will receive them. At the end of the webinar, I will ask the questions on your behalf. You can also collapse the menu by clicking on the little arrow on the top of your control panel so that you can have a full screen view. Andrew, over to you.
Thank you, Andrew, and a very good welcome to all of you who've signed in today from the US, Europe, and out here in Asia. I'm Andrew Hoare from Pacific Carriers, which is the shipping arm of the Maritime Group. As already announced, we have a very distinguished panel today, two leading industry maritime analysts and thought thinkers, and Matthew Blake as well, a distinguished representative from the Shipping Corporation from Teekay. During our session today, I'm going to divide it up into two principal sessions. First, I'm going to ask Arjun to speak for maybe 5 or 10 minutes on one theme, and then Rahul will follow after that with some discussion in between to try and connect the two themes that are presented today. I think as transportation goes, with the exception of the cruise business, shipping hasn't done all that badly today, and we have essentially remained open, thanks principally to the good nature of our crews who serve on board our ships. The tanker sector has capitalized on the falling oil prices, particularly in Q2, to have quite a strong sector, as we all know. The dry bulk sector has picked up very well as China has reopened, swine flu has dissipated, and steel production has again commenced. Container sector, paradoxically, is doing very well because I gather something like 10% of what's been in containers today is PPE or PPE related equipment around COVID. But I think there's one signal that really is quite alarming this year, which shows that there is a distinct nervousness about the future, and that's that the order book this year is year on year 50% lower. So 50% less orders are being placed this year compared to last year. So that really shows that there is considerable uncertainty out there. We will probably discuss this later, whether it's COVID, whether it's propulsion or other factors. We shall wait and see. But without further ado, can I bring Arjun to present your slides, take us to just what financial recognition is going to come into the shipping industry that has actually kept trade flowing during this crisis.
Good evening, ladies and gentlemen, or good morning, depending on where you are. Well, it just happens today is the World Maritime Day, and the theme for this year is sustainable shipping for a sustainable planet. So I think that's quite appropriate. Andrew, can you just go to the next slide, please? I think what we've experienced in the last 6 months or since COVID has really been what analysts call black swan events. I think really it's a black swan event to the power of 10. I don't think any analyst would have ever dreamt of such an event. And as Andrew quite rightly said, actually shipping has got through this reasonably unscathed, but other than our crews, our crews have had a horrid time in the last six, seven months, but and things are improving, but still quite hard for most crews. But outside shipping, economies, businesses, people, they've had an incredibly hard time, both personal and economically, huge tragedies, business closing, people out of jobs, etc. Now, in my view, I don't think we are over it, even though we are, past the first wave. I definitely believe we are possibly only halfway, if that, through this. We are governments have pumped in huge amounts of money, which has kept the stock markets up, but businesses are still suffering across the board. Definitely the traditional businesses. Europe, UK, India are in their second wave of COVID. Whether we're going to see the third, I don't know, but I suspect governments will sort of run out of firepower. So in my sort of crystal ball, I think we have still another 12 months of pretty horrific real world economic news. I'm not talking about shipping, just the economic news. The vaccine everybody is hoping for, I think, is still a year away. That's unfortunately where we are. But just to put into perspective what I feel are the sort of things we should be doing to sort of bounce back, as Marine Money has asked us to talk about, well before COVID-19 even was on the horizon, the world, the global economies were experiencing mega trends, which, to be honest, was shaping how the world and the world economies were going to go forward. And I think one of the biggest sort of mega trends in our time, at least in the last 20 plus years, has been globalization. This interconnectivity of economics, of economies, of global trade, of outsourcing. All this has been an incredible boost to trade and definitely to shipping. We've all had great benefits of it. But as I suspect China has grown the sort of to become an extremely powerful economy on their own right, we've started to see geopolitical tensions. This is the trade wars which started under last year, and they've just sort of kept increasing. Digitalization and technology. I mean, the incredible progress that the internet of things, digitalization, connectivity have made in the last 10, 15 years in the sort of land side and in industry. And then I think the sort of forgotten part, possibly all this progress has led to quite a lot of tax or this thing effect on the environment. We've seen environmental issues coming to the forefront as we use more and more material intensity. The environment has paid the price for all of this. So I think these are the mega trends. COVID has only sort of accelerated these mega trends. The geopolitical element is a sort of reversal of globalization, digitalization. I will come to environmental concerns. I think most people, having seen their vulnerability due to a virus, have suddenly realized that they are actually quite vulnerable, and it's important for them and their next generation that we preserve the planet. So my view really for shipping to survive, to thrive post this crisis, now whenever that crisis is over, I think there are a couple of really major macro mega things we have to be thinking. Clearly, the environment, shipping really needs to start taking the environment a lot more seriously than it has up to now. Conservation, decarbonization, greenhouse effect, recycling, repurposing, reusing, reduce our sort of material intensity, renewable energies, etc. Now, a lot of the discussion we have on the environment is all focusing on what rules and regulations are going to come in, what the cost of this is going to be, etc. But in my mind, I think rules, regulations are really, really too slow. I think the consumer has really lost his patience on rules and regulations. And I think if we all wait for rules to change how we manage the environment and sustainability, I think it's going to be too late. We've seen the consumer rising and becoming more vocal about it. They're going to and have already started influencing their governments. They've started influencing companies. And really, the way I see it, more and more, if shipping or if for the fact any industry doesn't take environmental seriously, governments are going to start taking unilateral action against shipping companies, ship owners, etc. So as a shipping company, I think imperative for us all is to take the environment seriously, start taking action to change how we do business. I don't think we can survive unless we do that. Digitalization, Andrew, can we just go to the previous slide, please? Digitalization and technology. Clearly, shipping still, when we look at it as benchmark it against other industries, landside, shipping is still in the dark ages. I mean, in this day and age, almost most things are still manual. We've just started discussing data standards and processes and data exchanges. Bills of lading. I mean, we started talking 25 years ago, Bolero and e-bills of lading, and we still haven't got there. And then numerous examples of that. And the slide, I'm not going to go through it, but clearly there is so much technology, data, digitalization can do for smart supply chains. It can bring the increased productivity, reduce costs, increase connectivity, all of the things which we really need to go forward with. But part of digitalization is the ability to cooperate, exchange, and connect with others. So in my view, it is an imperative. Shipping is well behind the curve, and this is an opportunity for us to catch up and benefit from all the productivity gains and cost savings we can achieve using digitalization and technology. Andrew, next. Okay, so just to put where we are, clearly COVID has brought in a new normal. I mean, I don't think we have seen the end. We don't know what the new normal is going to be, but clearly whatever the normal is going to be different from what it was before. And for a ship owner, shipping to survive this, we need a new vision. Supply chains have to be more connected, much more transparent, and shipping needs to change to deliver this. In order to get the transparency, we need more collaboration. Of course, I've talked of the environment. So I think together with the digitalization, technology, and environment, I think we will achieve huge gains by optimization. This could be OPEX, time, fuel, inventory costs, a number of benefits we can get from this. And once we've achieved sort of optimization, we would become much more resilient for shocks, for out of normal events, and I think owners, shipping companies will become much more resilient, hopefully reducing risk, increasing returns. And really, as I say, this is an opportunity for us to rethink, recalibrate, and give ourselves a new vision to survive the new normal. Thank you very much.
Arjun, thank you very much for that very compelling case. Just a couple of questions before I open up to Matthew and Rahul. A lot of what you said would have resonated very well with the Z generation in this forum. I'm sure there are a few out there. But is not what you're saying about operational efficiencies, that sort of things, is that not just really an extension of commoditization? If we look at shipping, containerization, we look at aviation, we've actually seen that improving efficiencies in those industries has not actually helped the shareholders. It has actually not helped returns either. So is not one of the mystique of shipping the fact that we were able to benefit, for example, the tanker industry in Q2, because fundamentally we are quite a sort of unusual sort of dinosaur that exists out there. But whenever we've tried to improve our efficiencies, we actually destroy value.
Yeah, I don't think efficiency and improving our costs is connected with our ability to want to speculate and build. And I mean, historically, as owners have ended up for various reasons, either making speculative investments or trying to outgun each other, as in the container shipping business was, bigger the better, and everyone took out the nuclear weapons to get to the 23,000 TEU, and probably I don't think anything bigger than that, but who knows? And that's really been the cause, is to use size in order to bring costs. I'm not suggesting productivity and OPEX should be brought down by making, bigger the better. I think even what we have is to make them use them more efficiently. In the liner industry, I mean, capacity management, yield management. I mean, if you look at the airline industry, and I'm not saying the airline industry has made huge amounts of money for its shareholders, but definitely since the 90s done a lot better than shipping has in returning returns to the shareholders. I mean, container, I think this must be the first, Rahul, I'm sure will no doubt tell us, but this is after a long, long time that the container industry has, black there. So I don't think digitalization and technology is a route to self-destruction. I think it's just been loose money, speculative ordering, bigger the better, which has caused that. I think people have learned, Andrew. I think even what has happened in the last few months, where with capacity management, I think even the lines have learned that they need to manage capacity. It's not all about just low prices.
Thank you for that. And maybe turning to Matthew, I noted that Arjun was talking about in his slides regulation, potential taxation. Is Teekay ready to pay the carbon tax to be a good boy?
If there's a carbon tax on the industry, then Teekay will be paying it with everyone else. But it was an interesting sort of presentation from Arjun there. I kind of was nodding my head to a lot of the environmental changes that are coming along, but but shipping is also, as you pointed out, Andrew, we're kind of in that sort of special category of a sort of a slow-moving, slow-changing industry. So we have we have deadlines, or we have regulations coming up in 2030 and 2050 that will change the way ships are built and ships are operated. But I just and there will be sort of changes within companies, within the industry leading up to this, but I'm not sure that we're gonna sort of have the same focus as a lot of the land-based consumer industries when it comes to demand for change. I think shipping will change itself. There's a lot of the shipping bodies, Intertanko, others that are looking at this, but I just don't think it's going to be as quick as some of the other industries that you may want to look at here.
So Rahul, before you move into your high velocity slide, which I've had the privilege of looking at briefly, do you have any further comment on this? You're muted, I think.
Yeah.
Rahul, you're muted.
Yeah, so perfect. I think Arjun put it in very great perspective, right? In terms of longer term, what shipping needs to do. But I think we have been here and we've been talking about this for, I would say, over the last 10 years, right? I think IMO 2020, sulfur caps, these have been in discussions for a good part of over the last 10 years. I think what COVID does, and Arjun certainly mentioned about digitization as well as more demand from the consumers. I think shipping has come in mainstream. I think what IMO 2020 did earlier, as well as what we are seeing with the crewing crisis, it is in mainstream now. I think people who are not in the industry are talking about what's happening, right? So as the industry comes in the mainstream, it basically needs to get its act together, needs to be much more cleaner, and consumers will have to pay. I think we've been discussing this about over the last 5-7 years, but it's already happening. The consumers are paying. If you look at what's the container shipping companies have been able to charge. I think if you want those sneakers sitting at home, or if you want any of those new laptops or the TVs, they are paying through the roof. I think that's what would continue to happen. I've long said that the shipping costs have to move up. I think the way we've globalized as well as taken down the pricing in terms of freight cost, I think that will continue to move up. So COVID is that reset. I think it will certainly lead to across different sectors within the industry with a different impact. Some of them will pay higher, some of them would pay lower, but it will continue to go up. Yeah.
So thank you for that. I think
I might add just reply to Matthew.
Rahul, if you could bring them up.
Sure.
Andrew can bring them up.
Andrew? love to. Perfect. So I'll just quickly run through these, right? So I think Arjun put it, like I said, those are longer term, I would say next 3 to 5, 10 years, what needs to be done, right? I'm looking at what in terms of basics, what we are seeing, right? Right now, maybe let's say the next 6 to 12 months, 18 months. If you talk about what we're seeing out of China, it's been fascinating, right? I think it's not all gloom and doom for shipping. The headlines which have come off, I think with respect to the commodity markets, they have been truly fascinating. We're talking about multiple records for monthly commodity imports across markets, whether you talk about iron ore, whether you talk about copper concentrates, soybean out of Brazil, crude oil. So I think Chinese government and in terms of shipping, the industry which we all represent, I think the Chinese government stimulus package, which we have seen, and we're looking at the next 5 years plans which have come in, right? That will continue to support the demand. I think there is a strong infrastructure push. It's being talked about that it's the same thing which they do every time there's a crisis, but they do it well, and in the end it helps shipping, right? So we are seeing that play out as well. Next slide, please. I think some of these factors are playing out in the activity levels, or in terms of data as well, right? If you're looking at this is IHS Markit PMI, the recent data out of China, it is painting a picture of recovery. We're talking about expansion, not only manufacturing activity, industrial output, all of that is rising. So we have to, let's say, probably put some, I think I've heard about, as in put some credit in terms of what China has come and done, at least in the short term, in terms of supporting the shipping demand. Economic activity resumption has provided significant momentum, right? The global commodity markets, if you see the prices, and I'll take you back to February and March, and people were looking at the iron ore prices, oil prices, and all of these commodity markets and saying that the world is going to end, right? I think it hasn't panned out that way. So that's something which has been supportive. Maybe some of the markets have run ahead of fundamentals, they will correct. But as of now, what the data is telling us, there are already early signs of recovery. These were evident back in late 2Q, and they continue to be evident in 3Q, as well as we're expecting 4Q as well. If you look at the economic forecasts, next slides, please. If you look at the economic forecast this year, we're talking about 5%, 6% global growth dip, but across markets and major economies, we are expecting a stronger rebound next year, right? So that will flow into commodity demand. There is an expectation, and this is being built in, is the next phase of economic recovery is likely to be driven by infrastructure spending. Most of the countries, we talk about the US infrastructure, you talk about Europe, as well as, let's say, India infrastructure, that has lagged. So there is an expectation that the infrastructure investments, all the stimulus which is coming over the next 18 to 24 months will flow into infrastructure. That's very positive for commodity intensive demand. In the end, the derived demand which shipping relies on. The commodity prices have moved. I think this is the IHS Markit material price index. There are multiple factors which are driving it, right? We're talking about strength in Chinese demand, evident in terms of imports. There is an optimism that the worst of COVID-19 is behind. There would be localized lockdowns, but we're not going into man-made full-on lockdowns, which we saw early in the second quarter. You're talking about weaker US dollar. That's again a stimulus for the commodity currencies as well as commodity demand. So overall, I think the supportive monetary and fiscal policies, we will see all of that seep into commodity demand. So overall, if you look at, there's a small tailwind of global demand picking up as well. It's only China who's doing it. I think this shows you as well, the Chinese, if you look at the internals, the commodity shipments, right, we're talking about have outperformed largely. This has supported what we are seeing in shipping at this point of time, whether it's iron ore imports, which are pretty strong as well. Next slide, please. If you look at copper, right, I think that's something, again, a very, very Dr. Copper as we know it, the imports provide an evidence of Chinese industrial economic recovery, right? And as this continues, this will start percolating into external demand as well. This will start percolating itself into other parts of the global economy, and that should help provide another support to the shipping demand. Next slide, please. And I'm thinking, as in this is a key here, right? As in people do question whether these numbers are correct, or for the fact is what is China doing? It's just inventory he's talking, but we're talking about this Chinese steel production, which increased 8.5% year on year, right? This is the fastest pace in 6 months in August. There has been infrastructure spending surge, which we can see in the fixed asset investment data, which is coming in. The steel exports, and China used to be a big exporter over the last few years, we're talking about they're down, whereas we are seeing imports of steel products going up, right? Last month, they stood up 131% year on year. So all that is helping in terms of commodity demand. I think, next slide, please. So if you look at iron ore, this has been a question which has come to our desk very often. Why are iron ore prices so strong? People talk about gold, people talk about stock markets, but the fact is iron ore has been the commodity which has performed, or rather outperformed, all of these over the last 6 to 9 months. The seasonally adjusted imports, third highest in record August. If you look at Brazil as well as Australia, almost 100% of that is going into China. Even Indian exports, which are not there over the last few years, they've started coming up, and China has this insatiable appetite, and that's supportive of the demand. Quickly running into what we're seeing with agri as well. So there are all these pockets of demand which are coming in. Brazilian soybean, which we saw, China lapped it up. We saw that with the US exports of soybean picking up to China as well. All of that is supportive for the demand, and that plays around with in a sense providing a support to the rates which you've seen. We are not in a global financial crisis. I think this is not a structural demand destruction. I'll talk a bit about that as well. I think on the oil markets as well, next slide please. I think we all know how important is Chinese demand for the oil markets, right? When the oil prices crashed, and you can see in terms of loading, China effectively lapped up the crude oil from the global market, right? And it lent a critical support to the oil prices. What our high frequency data is telling us, that is some of that has eased off. The fresh crude oil loadings destined for China have slowed down, but now you see more US oil going into China, right? So overall, in that sense, we expect the crude oil imports will normalize, but it's still very supportive, and all of the world is under stress what China is doing in terms of supporting the global demand. So net in terms of shipping demand, I think the talk of gloom and doom, I think at the start of the year have proved to be overdone. I think it's not a repeat of global financial crisis when we had a structural destruction of demand. The demand basically evaporated for an extended period of time. I think in our view, this is more a short-term demand destruction and not a structural one. So that will manifest itself in supporting the shipping industry recovery. Lastly, I'll just get back to one slide. I think this does get lost, but next slide, please. Yeah, thank you. I think this is my long-term view, as in I've always maintained this, is the supply side dynamics that drive industry profitability, right? If this COVID-19 crisis would have happened back in 2013 and 14, we would have been seen a massacre in the industry. The rates in some cases are below break even, in some cases, but they're still above cash break even in most of the sectors which we are seeing, right? If you look at the crude oil market, strongest rates which we saw early this year, they've come down but started picking up again as well. So the supply side dynamics which drive the industry profitability, right? We're talking about the multi-decade lows in terms of new building contracts. I think if you look at our data, which go back to when we look at this data going back to almost 1950 or something, we're talking about 60% fall compared to orders last year, and this would be the lowest year for 1970. This does tend to get lost, but I think this is the key here, is the high uncertainty, which Arjun also talked about, environmental regulations, sulfur cap, CO2 emissions. This will keep most of the speculative money as well as owners to commit to the market. I think we will see a wait and see mode, not only for next 2-3 years, but for a very extended period of time. And all this will support shipping recovery. So we don't expect any new building orders, huge new building orders in the near future. And the unfolding scenario, which we call the supply normalization, will be the key driver of the industry recovery. With that, I'll end here. Thank you so much.
Rahul, thank you. That was an excellent snapshot and spoken hardly without breathing. So very good. If I just look at that a little bit, I can see the optimism on the dry side, because you can see the large infrastructure projects. I would say the crude side, I'm looking, is just an inventory game now. Inventories are filling again, they're swelling again. Even the Chinese independent refineries, they're exporting because it's full, and there does not seem to be any demand outside China. How long is this situation going to remain whilst the queen of the crap, jet fuel, frankly, is not being consumed?
I was coming to that. Exactly, and I think Matthew will add there more, but what we're seeing is jet is one of the biggest markets, right, in terms of the refined products. That's a critical component of it, and that doesn't look like to be coming back anytime soon. We started seeing recovery in gasoline as well as gas oil. We started seeing recovery in naphtha as well as other industrial refined products, but jet fuel continues to keep a lid on a short-term recovery. The good part is we saw a lot of floating storage back in May as well as June, July. That has started coming off. In the short term, it's negative, but it's also an indication of some of that demand recovering. As the industry or as the markets work through this floating storage, I think Q4 is where we would see some kind of demand bottoming, and next year we're expecting much better recovery in terms of global growth. So that would support the tanker markets in my view.
So Matthew, Q4, Northern Hemisphere winter, Is it going to bring any reprieve to today's current spot markets?
You know what? It's very interesting. I think 10 days ago we were getting a lot of inquiry for VLCCs. There were quite a few deals concluded. This week, absolutely nothing. You know, spot fixtures are being recorded in single digits or $12,000 a day. So I think it's going to come in waves. But yeah, I think, you know, we're a lot more balanced, or a lot more finely balanced, and these sort of small kind of interruptions to utilization will give us pockets of, you know, pockets of decent earnings over the winter. Having said that, we've also seen 3 named storms go through the US Gulf, and it hasn't really changed that market. And that's just a sort of sad indictment that we are overtonnaged coming into the quarter. But I think, you know, I think it is quite finely balanced, and hopefully we see a little bit of activity.
Arjun, looking at the new building situation, we're seeing the massive contraction in orders this year. We're not really seeing a significant drop in new building prices compared to, say, January, February. How do you think that that's going to pan out with the environmental challenges that you referred to before, with the choice of propulsion, etc.? How will this sector evolve in the next sort of 18 months or so?
I think the issues which are stopping owners investing in new buildings has not changed. I think the headline prices from yards continue to be headline. Yards clearly have capacity. They just don't have designs for the future. They don't know what to design for. Owners don't know what, you know, I mean, you know, if Teekay had to go in and say you have to be told that your VLCC is only going to last 10 years, the economics change so dramatically. Even if you put dual fuel today, I mean, you pay another 15 million or whatever to get dual fuel, put LNG tanks in there, and you know, yes, people say LNG is okay till 2035. So you say, well, I'm going to do my maths to write off that VLCC in 15 or 12 years by the time you deliver it. The economics change dramatically. You know, I mean, when I came in the industry, we happily put 25 years into our Excel spreadsheet, and the numbers look so interesting. And you know, I was working for a Greek owner, and we ended up buying lots of ships. You put 12 years into a VLCC, even with the extra cost of dual fuel, suddenly numbers don't make sense. So I think, and you know, sitting as a yard, I can see them. You know, yes, they still have some work to do. There's going to be a number of smaller private yards having to leave the industry. I think there will be some of the Japanese yards who have coming to the end of their economic life because labor costs have gone so high, etc. So I think the industry which is also going to revolutionize is the shipbuilding industry. So, you know, at a certain level, they can't drop their price below marginal cost. I mean, up to now, they played with marginal cost in order to give or fluctuate their shipbuilding prices. But, you know, no sensible business, unless it's subsidized, can really be building ships at below marginal cost. So, yeah, I'm not, in my own view is, I think shipbuilding is going to be rational. You know, people are not going to build that much unless, you know, somebody decides, you know, 40,000 TEU is the next line of shipping to do. But I don't think that is there yet. So I think we are going to have the next few years of low shipbuilding prices, which is good for the industry. I'm not as bullish as Rahul on the economics, you know, but on the supply side, which is something which has plagued the shipping industry all my career, I think that's under control. You know, and I think that's absolutely a fabulous situation. But the issue is, what now? What next?
Yeah, I think, and maybe if I can add to Arjun's point there, exactly. I think it's a supply side. Why I say that is container shipping is a very good answer, right? I think they couldn't put back ships back in service when the rates are at record high. So it takes something either what we saw in container shipping industry in this quarter, or let's say late 2Q and 3Q, was perfect supply squeeze, which happens in many of the industries across industrial markets, right? That is how the shipping should behave in that sense, right? So if you see a same thing, very unlikely on I would say on the bulk commodity side on dry and tankers, but this is where shipping basically becomes interesting now. I think over the last 10 years, and I've used that, maybe some of my clients would know what I said 5 years back, where shipping has to become boring again. I think it's becoming there. So that's what my 2 cents here would be on the supply side.
But I think, Rahul, to be fair, the liner shipping business has also consolidated considerably in the last 5-7 years. Part of what they're gaining today is discipline rather than capacity. I mean, with the number of blank sailings, etc. So blank sailings is not about supply, it's about discipline. And I think, you know, so I think the liner is benefiting from just rational thinking, discipline, and capacity management, which is possibly in the bulk sector, you can't, you know, it's very unlikely tanker owners are going to have blank sailings or not fix the next car.
Yeah, exactly. That's, I think it's also become easier to position your ships. I think that's what the industry is playing now with, right? I think you have access to, so we talk about digitization. I think that's also the opaqueness which was there in the bulk shipping industry has vanished over the last few years. I think it's easy to know where the ships are moving, where the ships are being positioned. So that also takes away a bit of a upside, I would say.
At this stage, Andrew, there are some good questions from the floor to bring up.
Yes, thank you, Andrew, very much. Yeah, we have quite a few questions. I can maybe, you know, ask a few now and then maybe ask a few a bit later on. Looking at tankers, one question came in saying, how should tanker owners make investment decisions given that China pledges net zero emissions in 2060 and BP sees peak oil is already behind us? Who would like to take that? Rahul?
I think Matthew's most exposed to that, so let's hear from Matthew first.
Yeah, it's a very long window for my outlook, but you know, I'd say if I'm like we've had this peak oil argument in the last couple of decades as well. It's never panned out. Who knows? I can't say it's there, can't say it's not there. 2060 for, you know, is it zero emissions from China? We're talking more than the life of a tanker and then some. I think the decisions now have to be based on sort of propulsion technology and efficiency. I think when I look at the order book, and I'm going to apologize now, my dogs are about to start barking, and nothing to do with answering this question. When I look at the sort of fleet profile, especially for the Vs and the Aframaxes, it's quite an old fleet, so there has to be a significant investment over the next decade, and I've seen figures of 12.5 billion a year invested just to stay at present levels. Now, obviously, we need to see in 2021 some demolition as well. But yeah, ships. I wouldn't be too concerned about the sort of 2060 deadline if you're placing the order in the next few years. And I think there are going to be some, with the low fleet growth that's been discussed, and the older fleet that that we have at the moment. I think we could see some good times ahead for tankers. But it's we need to see that demand come back to the market as well.
Thanks, Matthew. One other question on tankers. Q4 is historically the strongest quarter for tankers. Q3 is usually the weakest. Is Q4 shaping to be better than Q3? And are tankers expected to be above break even in the fourth quarter of the year?
We say we hope so.
Yes, Q4, the Q3 is not ending on a high note, so Q4 is not going to start on a high note. But I think, as we said earlier, there's as the sort of data we've seen on China, it shows that the demand is there. The trading community seems to value a VLCC one week and not the next week, so I think we will see pockets of interest in Q4, and it's definitely not a quarter that we're writing off, I think it has every potential to be as strong as Q3, if not better.
Thanks, Matt. Moving on to some comments that were made towards the beginning of the panel discussion on the environment and ESG, and that's something that also, Marine Money has been focusing on during this week's sessions. A question that came in is, will digitization and regulations and ESG squeeze the smaller owners out, and is the future fewer bigger owners and operators? Arjun?
I think I just one step back. I think the issue, what happens is, as markets become more transparent, the spot market and the volatility becomes a lot dampened. And I think the issue of small ship owners versus big ship owners, we know when you talk of their ability to finance or regulations, etc. But I think the other problem, which a lot of small owners have found attractive, is the volatility, the cyclicality. Traditional Greek owner being absolutely fabulous players of the shipping cycles. I think as markets become more transparent, we know where every barrel of oil is, we know where every ship is sitting. All of a sudden, I don't expect the volatility to exist or the cyclicality to exist. Volatility due to external events would happen. So I think the difficulty is those players who came in for the big cycles, buy low, sell high, not depend on ship finance, etc. This industry is going to start looking boring to them. And therefore, it's going to be the big industrial players like Teekay, who are very connected with the big oil companies, who will more and more thrive. Maybe the returns will fall, but the risks will also fall to make it an attractive industry. So I think the high risk, high return players will find the industry more and more boring as we become more sustainable, more multiple fuels, etc., etc. That's my opinion.
Mm-hmm. Yeah, thank you, Arjun. On technology, a question on blockchain, perhaps for Rahul. How does the panel see blockchain playing out, and how does the panel what's the role of blockchain for the future of shipping? Well,
yeah, I think Arjun put it very nicely when he said the industry is still in dark ages, right? So I think we're still there. Blockchain has been coming up over the last few years. We ourselves do some of that stuff within our company as well. But I think for the industry, as the moment it came and it went away. I think container shipping one, which picked up, we saw some of the transactions happen on the bulk side as well. But even for that matter, till the time we get to the simplest of e-bill of lading, I think blockchain is still far away. But there are lots of exciting things happening, and the one thing which I wanted to mention is what I've seen over the last 3 years is there has been a move away from assets, in a sense, towards technology, right? So the ship owners are talking more about digitization now. They're spending money there. We see that in our business as well. We see that with lots of startups, tech accelerators coming up, which are supporting industries or newer companies which are talking about, as well as the proof of concepts and companies who are actually doing this, right? So that's a change which you've seen over the last few years, and it certainly will only continue to grow. I think the move away from shipping assets or pure play shipping assets and more towards technology supporting the supply chain is where the industry is headed.
Thank you, Rahul. Okay, just a final one from our side. If we, and maybe everyone can kind of, tell us what they think on this question. If we go forward 5 years, might we look back and see COVID as the catalyst for changes which were much needed in shipping? Andrew, perhaps we can start with you.
I think when we look back at COVID in 5 years' time, we will be quite ashamed of ourselves, how we probably didn't look after our crew very well at all. People who've been in quarantine for 6, 7, 8, 9 months or so forth. So I think that'll be the biggest lesson for the shipping industry, for one sense. The other lesson, I think, is those that were prepared with good BCP plans will come out of this stronger than those who were not. I think probably nobody was as ready as we hoped we were, I think those that were more ready than others will be much stronger to weather the storms ahead. So in 5 years' time, make sure you have a good BCP plan in place for the next crisis, whatever that might be.
Rahul
Yeah.
or Arjun?
Arjun,
Go ahead.
Okay, I'll take it on. I don't think COVID is the last crisis we are going to see. I think the world is changed. I forget shipping. I think the world will have dramatically changed at the end of this COVID cycle. You know, how we work, how we play, how we spend, how we do business. I think shipping, unfortunately, is behind the curve today and will continue to be behind the curve 5 years down the line. And we will possibly, maybe at a very different level, maybe talking very different things, but we will still be talking about shipping in the dark ages 5 years down the line.
I would, yeah. So that's a very pessimistic view from Arjun. I think shipping will do okay. It certainly hasn't. It'll move. But the fact is, I think this will be remembered for, I would say, the more of an economic crisis, right? I think if we go back, we had 2008 and 9. That economic crisis had a major impact on shipping, right? That was what I'm trying to say here. Is it's not the same global financial crisis for shipping. So that's a distinction I'll make. It will come and go. The impact on global economy is much bigger than on the shipping industry.
Matthew?
Yeah, no, I think, you know, I'm hoping COVID is a once in a lifetime event. I hope I don't see another one like it in my lifetime. But, you know, as Arjun says, maybe there is something else coming down the pipe. Andrew kind of hit the nail on the head. I think the crews have been treated very badly. And I think we need to learn how to respect their time and their sort of safety a lot more. And I think shipping will learn, but you know, what those lessons are going to be. Hopefully it's discipline and ordering, which I think we're going to get anyway with technology.
Thank you, Matt. Andrew, perhaps one more round of a question from you.
Yeah, I'm probably done. Does anybody else have any questions amongst ourselves? I think, you know,
Okay.
again, I think two great presentations, very different themes, but they do connect at the end of the day. We have to find those themes to connect. It's great to end a Marine Money series with a very, very optimistic, upbeat outlook. I hope the tankers can find some good fortune in Q4. But no, I think it's been great to be part of this panel. And look forward to the one next year being face to face.
Yeah, thank you. And on that issue, I mean, because you know, Andrew, Rahul, Arjun, Matthew, you're all based in Singapore. On behalf of some of our international listeners tuning in, when do you think Singapore will be open for travel again? And when do you think that we might be able to see each other face to face once more?
I think they've just, the government's just introduced a sort of business travel program. I don't know the details of it, so there will be some business travel in and around Singapore. But for general travel, I don't know. Not this year, probably not until closer to the middle of next year, maybe.
Mm-hmm. Okay, thank you so much. So again, Andrew, Arjun, Rahul, Matthew, and also Nick for his presentation earlier. Thank you for being with us today. For those of you in the audience listening in, this webinar is being recorded and it will be posted on our website later today or tomorrow. We will also be sending a follow-up email in the coming days with some contact details. So if your question wasn't answered by the panel today, you can follow up with our speakers later in the week. That brings us to the end of our virtual Ship Finance Week. We hope that you enjoyed the sessions brought to you by our Marine Money offices in Singapore and New York. Once again, we'd like to thank our partners, our sponsors, and our supporters. All of the week sessions will be made available on our website, and links to the webinar recordings will be sent to all registrants in the next couple of days. From me and from Marine Money, thank you very much for joining us. for joining Virtual Ship Finance Week, and we hope to be with you again soon. Thank you very much, everyone.
Thank you.
Thank you.
Thanks.